I think what's interesting is the two ish, the two areas you look at, right? You look at the long duration the bonds, which obviously yield has come up. So when you look at it from the standpoint of where bonds were at 60 bips not too long ago to 112 bips where they are today, that shows that there's been a substantial move up and a substantial steepening, which is of course helping banks. But at the same time, you're seeing other factors like the market's hitting highs consistently and more stimulus being fed into the market. So I think there's a number of factors taking hold today, and the market's trying to figure out which narrative that they should go with. And for the past 9 months, almost in a straight line, it's been up in terms of equity markets. I think what ends up happening is, will so much be built into the market, and will eventually we start to see factors of inflation take hold, and those are the things I think that could ultimately pop the epic bubble.
David, we heard from Joe Biden yesterday talking about the haste required to bring people back into the workforce and provide stimulus and support at this point. Your research, you're comparing this spending plan and getting people back into the workforce quickly to the 1920s, which led to the 1929 market crash. Should we be concerned about an event like that on the back of these policies?
I think so because, like I said, my reference to you guys was that you had the destruction of World War One lead into the Roaring Twenties, and then of course what happened in the Roaring Twenties, what led after that was of course the 1929 stock market crash and the Great Depression. So I think you got to be careful what you wish for. So you're seeing this massive, $1 trillion deficit spending due to a pandemic that has of course stopped the world in the past 9 months. And the goals, of course, are, we're going to get vaccine, we're going to come through this. We still don't know the dynamics as to how fast and swiftly we come through this. We also don't know what global growth will look like in the future years too. So, the anticipation is we'll have GDP growth come up to, 6.5% for 21. But I think if you start to look beyond that, you're going to see more normalization of GDP growth of 3% and back down to 2.5%. And you have an aging demographic here in the US. So I have a hard time thinking that even with all the stimulus that you're seeing in this system, that it's going to lead to consistent, steady growth. And instead, I think what you'll find is we'll have large growth maybe in 21, but then start to see subdued growth. And then eating that with the fact that you have so much debt, both in the corporate and with government, it's going to be a tough road ahead, I believe.